Have you ever, glanced at a news headline, saw a few numbers, and felt like, okay, I've got the whole story? Well, today, we're going far beyond just the headlines. We're going to peel back the layers, really, on a fascinating set of documents. We want to uncover not just what happened with the company's financials, but why it matters, and maybe more importantly, what it tells us about the bigger shifts happening in a really critical global industry. So, our mission today is to dive deep into the latest info from Cyient DLM Ltd. We're dissecting their financial results for the first quarter of fiscal year 2026. That's the quarter ending June 30, 2025. We've got the official outcome of their board meeting, their unaudited financial results, both consolidated and standalone, and their investor presentation. All fresh off the press, released July 22nd, 2025. Our goal here is to pull out the most important nuggets of knowledge, the key insights, basically giving you a shortcut to being, properly informed about this key player in the electronics manufacturing services space, the EMS space. Okay, let's unpack this. This isn't just about reading balance sheets, right? It's about understanding the strategic moves and those powerful industry trends that are shaping this company's future. And we've got some really interesting contrasts in these numbers that I think will spark some aha moments for you. So, right off the bat, let's look at the board of directors meeting. It wrapped up on July 22nd. Beyond just approving the financial results for the quarter, which you'd expect, the board also greenlit conducting a postal ballot. That's to get shareholder approval for appointing Mr. Rajendra Velagapudi as a managing director and chief executive officer, although the investor presentation already lists him as CEO and MD, so this seems like finalizing the formalities. And importantly, they reconstituted two key committees. First, the Stakeholder Relationship Committee, that's now chaired by Ms. Vinitha Datla, an independent director, with Mr. Krishna Bodanapu, also independent, and Mr. BVR Mohan Reddy, who's non-executive, non-independent. Then there's the Nomination and Remuneration Committee. Mr. Madana Palutla, independent director, is the new chairperson, with Ms. Vinitha Datla and Mr. BVR Mohan Reddy as members again.
Yeah, and what's fascinating there, I think, isn't just the administrative side of changing committees. This really reflects a deliberate strategy. They're strengthening independent oversight in pretty crucial areas like how executives get paid and how the company engages with its stakeholders. It signals a more robust governance framework. It feels like they're proactively positioning the company, setting up that underlying structure to support their strategic direction and future growth.
That makes sense. Sort of laying the groundwork, that proactive approach certainly sets the stage. Okay, now let's pivot to the numbers, the Q1 FY26 financial performance. Let's focus on the consolidated figures first. The top line, revenue, looks pretty good. Revenue from operations hit about $2,784 million. That's an 8.0% increase year on year. And their EBITDA, that's earnings before interest, taxes, depreciation, and amortization, also showed real strength. It grew significantly to $251 million. That's a, 25.3% jump compared to last year. And this even pushed their EBITDA margin up to 9.0%. That's a solid 125 basis point improvement. Pretty healthy stuff there.
It is healthy. Operationally, things look strong.
Here's the twist. This is what immediately jumps out when you look at the report. Despite that strong revenue and EBITDA growth, the net profit for the period that paid out actually declined, and significantly. By 29.6% year on year, it fell to about $74.6 million from over $105 million last year. And correspondingly, earnings per share also dropped from 1.34 down to 0.94.
Right, and that's quite a divergence, isn't it, between the strong revenue, the strong EBITDA growth, and then this drop in net profit. So from your perspective, looking at the documents, what are the key factors driving that disconnect? When you see revenue and operational profits up, but the bottom line, the net profit, is down, what's usually going on under the surface?
That's an excellent question, and it really gets to the heart of, understanding these financial reports beyond just the headlines. The sources point to a couple of key reasons for that PAT figure looking the way it does. First, other income was noticeably lower this quarter. And the reason given is basically that the funds they raised from their initial public offer, their IPO, have been utilized, put to work. So that means fewer deposits sitting in the bank generating interest income. It's a direct consequence of actually using that capital.
Okay, so that's one piece.
Yeah.
Using the IPO money. Makes sense. What else?
The second piece, and this is a big one, is a substantial increase in depreciation and amortization expenses, D&A. These rose pretty steeply to $105 million in this quarter from just $67 million in the same quarter last year. That's a 57.1% increase. Now, this jump is specifically called out as being due to the amortization of intangibles, things like goodwill or customer relationships acquired as part of a deal, specifically from the entity they acquired, Altec Electronics Inc. That acquisition became effective back in October 2024. And for you listening, it's really important to remember that amortization, like depreciation, is a non-cash accounting item. It's basically spreading the cost of those intangible assets over their useful life on the books. It hits the reported profit, the P&L, but it doesn't represent actual cash leaving the company's bank account in that specific period.
Got it. So we're seeing the strategic use of IPO funds, reducing interest income, and then this accounting impact, this non-cash charge from a major acquisition, hitting the reported net profit.
Hmm.
It's not necessarily reflecting a decline in the core operational efficiency of the business itself. That makes a lot more sense, especially when you pair it, like you said, with a strong EBITDA performance. It actually sounds like they're making investments, deploying capital, integrating an acquisition that are just temporarily impacting the bottom line number, but could be very beneficial for growth down the road.
Exactly. That's the story these numbers seem to tell. And just to add a bit more context there, while the overall revenue did increase year over year, the growth was also affected by the completion of a particularly large order back in FY25. That sort of baseline effect was then offset by bringing in the revenue from the Alltech acquisition, which only really started contributing in the second half of last fiscal year. So you see this dynamic shift in where the revenue is coming from.
Right, different streams coming online as others phase out.
Precisely. And on the cost side, it's interesting, they actually improved their material cost ratio. The report says that's due to a better product mix and some supply chain efforts paying off, particularly getting lower material costs in their U.S. operations now. However, employee costs and other expenses did increase year over year, but again, that's largely attributed to including those new U.S. operations from Alltech.
So higher costs there, but potentially offset by better material margins and definitely bringing in new revenue streams.
Exactly. So what does this all mean for you when you're looking at financial reports like this? It's just such a crucial reminder that the net profit figure isn't always the full story. You can't stop there. Sometimes a decline like this can actually be the result of healthy strategic investments like acquisitions and these non-cash accounting items. It's not necessarily a red flag about the core business performance dropping off.
Absolutely. Digging deeper is key.
And looking beyond just profit, the company also showed significant financial health in another key area, cash flow. They generated positive consolidated free cash flow FCF of about INR 802 million for this quarter, Q1 FY26. And importantly, that's their third consecutive quarter of positive cash generation. That's a really powerful indicator of liquidity and operational efficiency. They're actually generating cash, not just accounting profit.
Yes, this is critical. It really shows the company's ability not just to book sales or show profit on paper, but to actually convert those earnings into real cash. And that cash flow, well, it's vital for long-term sustainability. It funds future growth, pays down debt, maybe returns capital to shareholders, all without relying too heavily on external financing. Plus, when you combine that strong cash flow with their record order intake, I mean, that's impressive. They took in around 5,150 million in new orders during the quarter. That's their highest quarterly order intake in the past 10 quarters, so over 2 years. And this significantly boosted their total order backlog up to 21,318 million. The report also notes that nearly half of this new intake is executable within this fiscal year, FY26. That provides really strong visibility into future revenue streams and definitely validates the demand for their services in the market.
Okay, so we've kind of dissected the numbers, understood the profit nuances, seen the strong cash flow and order book. But these aren't just figures on a page, right? They're reflections of a larger strategy playing out. So let's zoom out a bit and look at how Cyient DLM is positioning itself within the wider global EMS industry to, well, capitalize on the future trends. The context here is that the global electronics manufacturing services industry is projected to keep growing pretty steadily. We're talking a compound annual growth rate, or DAGR, of around 6.9% between 2025 and 2032. That could potentially push the market size to over $1 trillion by 2032. It's a huge
A massive opportunity, yeah.
And a major trend within that market right now is this shift towards regional manufacturing. You often hear it called the China Plus One strategy. Basically, U.S. original equipment manufacturers, the OEMs, are actively looking to de-risk their historical dependence on China for manufacturing. This is driving a shift towards nearshoring, bringing production closer to home, and also more local-for-local manufacturing strategies. And India, interestingly, is increasingly seen as a preferred partner in this shift. It's known for having cost-effective labor, particularly skilled in what's called high-mix, low-volume assembly, basically, complex products made in smaller batches.
Which sounds like a sweet spot for certain types of electronics.
Exactly. And this is where Cyient DLM seems to have a clear strategic advantage playing out. They're leveraging their existing facilities in India, but now combined with their strategic U.S. operations, thanks to that Alltech Electronics acquisition. This gives them a dual footprint onshore in the U.S., offshore in India. And the idea is this helps them optimize costs, manage compliance across different regions, build supply chain resilience, and importantly, navigate things like tariffs more effectively. According to their presentation, this proactive positioning has already led to a surge in engagement from U.S. companies. They're seeing more requests for quotations or RFQs and more inquiries about long-term sourcing partnerships.
That dual footprint strategy does sound strategically very sound, especially given that global de-risking trend we're seeing everywhere. But I wonder, are there unique challenges to managing operations across two pretty distinct geographies like India and the U.S.? Especially when you think about compliance, supply chain nuances, cultural differences. How does a company like Cyient DLM plan to mitigate those potential friction points?
That's a really perceptive point. Managing different regulatory environments, complex supply chains stretching across continents, different work cultures, it's definitely a challenge. And Cyient DLM seems to be addressing this through a multi-pronged approach, which is pretty evident when you look at their stated growth strategies in the investor deck. They're not just, passively reacting to these trends. They're actively trying to strengthen their core business first. That means focusing on winning larger deals and diversifying further into sectors they see as high growth, particularly medical and industrial. We saw the impact of that already in the revenue mix.
Right, building on existing strengths while expanding.
Exactly. And then there's inorganic expansion. They're explicitly stating they're targeting more acquisitions, specifically looking for companies that bring a new technology focus, maybe get them closer geographically to key clients, expand their overall footprint, or add new capabilities to their arsenal. Another key strategic move they highlighted is strengthening their build-to-specification offering, or B2S. Now, this is interesting. It means they don't just manufacture based on a client's existing design. They actually help develop and then manufacture products designed precisely to a client's unique requirements. It's a higher value-add service.
More of a partnership model than just contract manufacturing.
Precisely. And they're focusing this B2S push on specific areas like power electronics, sensing technologies, and the Internet of Things, or IoT. Hot areas. Okay, what else? They're also leveraging their ITAR certification. That's the International Traffic in Arms Regulations. This certification is absolutely crucial if you want to handle sensitive defense-related components and projects, particularly for the U.S. market. Having ITAR gives them a distinct advantage and a pathway to enter the U.S. defense segment, which they explicitly mention as a target.
That's a significant barrier to entry bypassed.
Definitely. They're also expanding into the automotive sector, again with a specific focus on electric vehicles, EV, and advanced driver assistance systems, AT, another high-growth, tech-heavy area. And finally, tying it all together, they aim to grow their existing client relationships by offering both onshore U.S. and offshore India models, playing directly into that dual footprint strategy we talked about, giving clients options.
Wow, that is a comprehensive strategy. It really shows a clear roadmap for growth, doesn't it? They're not just aiming to expand their existing capabilities, but very intentionally entering these new high-growth sectors and geographies. The blend of organic growth focus, targeted acquisitions, and leveraging key certifications like ITAR, it paints a pretty compelling picture of their future trajectory, I think.
Agreed. Okay, let's turn now to some specific operational highlights and a closer look at the segment performance for Q1 FY26. On the business wins front, they mentioned adding one new global logo in the quarter, Deutsche Aircraft. That's a significant name, certainly a validation. They also said two major B2S orders that build to specification type are in the final stages of being signed. And interestingly, two new accounts that they added just within the last year are apparently on track to become multi-million-dollar accounts within the next 12 months. So scaling up new wins quickly.
Good momentum there.
Yeah, seems like it. Operationally, they reported their highest book-to-bill ratio in the last 8 quarters. Now, for you listening, what that means is the value of new orders they received significantly outpaced the value of products they actually shipped and billed in the quarter. It's a strong indicator of future demand growth.
The demand is outpacing current shipments. Very positive sign.
Very positive. They also mentioned a strong focus on factory automation and digitization, making their manufacturing smarter and more efficient. And alongside that, continued efforts to strengthen their sales teams outside of India and really beef up that B2S capability through investing in technology and people. Okay, let's look quickly at their revenue mix by industry for Q1, consolidated numbers again. Aerospace remains a really strong pillar. It accounted for 40% of their total revenue and showed healthy 63% year-on-year growth, so core strength there. However, the most significant shifts, as we touched on, are really visible in industrial and medtech. Industrial made up 23% of revenue, but experienced, well, explosive 425% year-on-year growth, and medtech contributed 22% of revenue, also showing very strong 142% year-on-year growth.
Wow, huge jumps.
Huge jumps. And both of these surges are directly attributed in the report to the inclusion of their new U.S. operations from the Alltech acquisition. Conversely, the defense segment was 9% of revenue but saw a sharp 82% year-on-year degrowth. But again, that was primarily explained by the completion of one very large order back in FY25, so it's more of a baseline effect than a collapse in demand.
Okay, so context is key for that defense number.
Absolutely. Now, if we slice the revenue by product category instead of industry, printed circuit board assembly, PCBA, was the largest chunk at 53% of revenue. Its share declined slightly, again, partly due to large orders closing. But box build, which is basically assembling the final product and its enclosure, contributed 29% of revenue and showed strong 66% year-on-year growth. And mechanical and others, which includes things like machining or component manufacturing, saw really impressive 318% year-on-year growth, making up 17% of revenue. Again, largely driven by those U.S. operations coming online. Cables were a small 1%.
So growth across multiple product types, especially the more complex assemblies and mechanical parts.
Seems so. And geographically, just to round that out, a significant 90% of their revenue actually came from the rest of the world, meaning outside India. Only 10% was domestic from India. This reflects that increasing demand they're seeing from customers outside India, particularly fueled by the U.S. presence now.
Yeah, that geographic split is striking. It really underscores the global nature of their business now. And this whole breakdown across industries and products clearly illustrates how those recent strategic moves, particularly acquiring Alltech Electronics, are fundamentally reshaping Cyient DLM's revenue composition. You can really see a strategic diversification happening in real time. They seem to be moving away from, perhaps, an over-reliance on single large orders or maybe a more limited product range in the past. Now they're pushing strongly into these high-growth sectors like industrial and medtech, leveraging those acquired capabilities. It highlights what looks like a very successful integration so far, and a deliberate shift towards a more global and hopefully more resilient revenue base for the future.
Well said. So we've really taken a deep dive today, haven't we? Moving way beyond just the headline numbers to try and understand the underlying drivers of Cyient DLM's Q1 FY26 performance. We've seen how strategic investments, things like acquisitions, even if they impact the immediate net profit figure due to non-cash items like amortization, can actually powerfully position a company for long-term growth in a really dynamic industry like EMS. The story here seems to be one of adapting proactively to global shifts like that China plus one manufacturing trend, leveraging acquisitions smartly, and really focusing effort and resources on high-growth sectors and technologies.
It's a picture of strategic adaptation and investment, definitely.
Yeah. So as we wrap up, what's maybe next for you, our listener, to consider? Here's a final thought to mull over. Given the increasing complexity we see everywhere in global supply chains and the incredibly rapid evolution of technology in sectors like electric vehicles, medtech, and defense, how might the continued execution of this dual footprint strategy, that blend of onshore and offshore manufacturing by companies like Cyient DLM, how might that fundamentally reshape not just manufacturing innovation, but also global economic interdependence in the years to come? Something to think about.